Imagine for a second that you are walking into a restaurant. You are hungry and you want something simple and healthy. On one side of the menu, you see ETF Salad. On the other side, you see Index Fund Salad. You look at the ingredients and they look identical. They both have lettuce, tomatoes, and cucumbers. But the waiter tells you that one costs less if you order it at a certain time of day, and the other one has a slightly different tax implication if you eat it on a Tuesday. You are confused. You just want to eat. This is exactly what it feels like for millions of beginner investors trying to choose between an ETF and an index fund. They hear these terms thrown around like they are completely different animals. They hear gurus arguing about which one is superior, and they freeze. They leave their money sitting in a checking account earning 0.01% interest because they are terrified of making the wrong choice. But here's the secret that Wall Street doesn't want to simplify for you. These two things are almost exactly the same. They are like Coke in a glass bottle versus Coke in a can. The liquid inside is identical, only the packaging is different. However, choosing the wrong packaging for your specific situation can actually cost you thousands of dollars in hidden fees and taxes over your lifetime. My name is John, this is the Penny Plan, and today we are going to end the confusion once and for all. I'm going to break down the Coke versus Pepsi battle of the investing world, show you the three critical differences that actually matter, and help you decide which one belongs in your portfolio so you can stop stressing and start compounding. Before we declare a winner, we have to identify why this simple choice has become so complicated. The enemy here is financial jargon. The finance industry is designed to be intimidating. They use acronyms like ETF, NAV, expense ratio, and bid-ask spread to create a barrier between you and your wealth. Why do they do this? Because if investing seems hard, you will pay someone else to do it for you. You will pay a financial advisor a 1% fee to pick funds that you could have picked yourself for free. They profit from your confusion. They profit from your fear of making a mistake. The other enemy is the optimization trap. This is a psychological hurdle where you refuse to take action until you have found the perfect solution. You spend weeks researching ETF versus mutual fund versus index fund, trying to squeeze out an extra 0.05% of performance. But while you are paralyzed by analysis, you are losing the most valuable asset you have, time. Every day your money sits in cash. Inflation is eating it alive. Every month you delay investing, you lose a month of compound growth that you can never get back. The cost of waiting for the perfect answer is infinitely higher than the cost of picking a good enough answer today. The truth is, whether you pick an ETF or an index fund, you are already winning. You are already in the top tier of investors just by choosing low-cost, passive investing over expensive active management or day trading. The difference between these two vehicles is minor compared to the difference between investing and not investing. So today, we are going to cut through the jargon. We're going to ignore the noise. We're going to look at the mechanics of how these funds work, not to make you a finance professor, but to give you the confidence to press the buy button. Let's start with the basics. What exactly are we talking about here? To understand the difference, you first have to understand the similarity. Both ETFs, exchange-traded funds, and index funds are baskets of stocks. Imagine you want to buy the S&P 500, the 500 biggest companies in America. You could go out and buy shares of Apple, Microsoft, Amazon, and 497 other companies individually, but that would be a nightmare. It would cost a fortune in trading fees, and you would need millions of dollars to buy them in the right proportions. So instead, financial companies created a wrapper. They bought all 500 stocks, put them in a big basket, and said, you can buy a slice of this basket for a small fee. That basket is the index. Whether you buy it as an ETF or a traditional index fund, the ingredients, the stocks inside, are the same. So what is the difference? It comes down to how they're traded, how much they cost, and how they're taxed. Difference number one, how you buy and sell. This is the Coke bottle versus Coke can analogy. An ETF trades exactly like a stock. You can buy it at 10 a.m., you can sell it at 2 p.m. You can see the price ticker moving up and down every second of the trading day. If the market crashes at noon, you can panic sell at 12:01 p.m. Please don't do that, but you can. You buy ETFs in shares. If one share costs $400, you generally need $400 to buy it, although many brokers now allow fractional shares. An index fund, specifically a traditional index mutual fund, operates differently. It only trades once a day after the market closes. It doesn't matter if you put in your order at 9 a.m. or 3 p.m., your trade gets executed at the closing price of the day. You don't see the price moving. You buy index funds in dollars, not shares. You can say, I want to invest exactly $500, and the fund will give you exactly $500 worth, down to the decimal point. Winner, if you are an active trader or you want control over the exact price you pay, the ETF wins. If you're a passive investor who wants to automate everything and invest exact dollar amounts, like $100 a month, the index fund wins on simplicity. Difference number 2, the minimum investment. This is crucial for beginners. For ETFs, the minimum is usually the price of one share. If you want to buy VOO, Vanguard's S&P 500 ETF, it might cost over $400 for one share. If you only have $100 to invest, you might be out of luck unless your broker supports fractional shares. However, many ETFs have much lower share prices, sometimes as low as $50. For index funds, there is often a minimum initial investment required to open the account. For some Vanguard funds, this can be $3,000. That is a high barrier to entry for a beginner. However, once you're in, you can invest as little as $1 at a time. Other brokers, like Fidelity or Schwab, have lowered their index fund minimums to $0, leveling the playing field. Winner, if you have $0 and want to start with $50, an ETF with fractional shares or a zero minimum index fund, like Fidelity's, are tied. But be careful of the high minimums on some premier mutual funds. Difference number 3, tax efficiency. This is the hidden killer. This is where you can lose money without realizing it. ETFs are generally more tax efficient. Because of the way they are structured, a process called in-kind creation and redemption, which we won't bore you with, they rarely pass on capital gains taxes to you while you are holding the fund. You only pay taxes when you sell. Index funds can sometimes trigger a tax bill even if you didn't sell anything. If other people leave the fund manager might have to sell stocks to pay them out, which creates a capital gain that gets passed on to you. You get a tax bill at the end of the year just for holding the fund. Crucial caveat, if you are investing in a retirement account like a Roth IRA or 401k, this does not matter. Taxes are irrelevant inside those accounts. This only matters if you are investing in a standard taxable brokerage account. Winner? For a taxable account, ETFs are the clear winner. For a retirement account, it is a tie. Difference number 4, the expense ratio, the fee. Both vehicles are incredibly cheap compared to the old days. You are looking at fees like 0.03% per year. That means for every $10,000 you invest, you pay $3 a year. That is practically free. Historically, ETFs were slightly cheaper, but recently, index funds have lowered their prices to compete. Fidelity even has zero expense ratio index funds, FZRO. You literally pay nothing. Winner? It is a tie. We are splitting hairs over pennies here. Both are excellent. Difference number 5, the behavioral risk. This isn't about the math, it's about your brain. Because ETFs trade like stocks, they tempt you to act like a trader. You see the price drop 2% at lunch and you feel the urge to sell. You see it jump 2% and you want to buy. The liquidity is a double-edged sword. It gives you the freedom to hang yourself. Index funds protect you from yourself. Because you can only trade once a day, you can't panic sell in the middle of the day. By the time the market closes, you might have cooled off. Also, index funds are perfectly designed for automatic investing. You can set up your bank to send $500 on the first of the month, and the fund buys exactly $500 worth automatically. With ETFs, you often have to log in manually to make the trade, though this is changing with some modern apps. Winner? For behavioral safety and automation, index funds are the king. They force you to be disciplined. So we have looked at the differences. ETFs are tax efficient and flexible. Index funds are simple and automated. You might be leaning one way or the other. But here's the twist. The biggest mistake beginners make isn't choosing the wrong one. It is thinking that this decision is permanent. You are allowed to switch. In fact, many successful investors start with one and graduate to the other. Here's a common strategy. When you're just starting out and you only have $50 a month to invest, you buy ETFs, fractional shares, because there are no minimums. You build up your portfolio brick by brick. Then, once you hit that $3,000 or $10,000 milestone, you sell the ETFs and move the money into an index fund inside a tax-advantaged account, so you can set up automatic investing and never look at it again. Or you do the opposite. You use index funds in your 401k because that's what is offered, but you use ETFs in your personal brokerage account to keep your taxes low. The twist is that you don't have to be on Team ETF or Team Index Fund. You can be on Team Wealth. You use the tool that fits the specific job you are doing right now. If you're digging a hole, use a shovel. If you're driving a nail, use a hammer. Don't argue about which tool is better, just build the house. And here's the other twist. In some cases, they are literally the same fund. Vanguard, for example, has a unique structure where their ETFs and index funds are just different share classes of the same pool of money. VOO, the ETF, and VFIAX, the index fund, are the exact same product. The returns will be identical. The debate is largely an illusion. So, here is the final verdict. Which one should you invest in? If you are investing in a taxable brokerage account, go with ETFs. The tax efficiency will save you money over the long run. If you are investing in a Roth IRA or 401k and you want to be completely hands-off, set it and forget it, go with index funds. The automation and the inability to panic sell are worth their weight in gold. But above all, remember this. The person who buys the wrong fund but starts today will be infinitely richer than the person who spends another year trying to pick the right fund. Imperfect action beats perfect inaction every single time. Stop overthinking the packaging. The salad is healthy either way. Just start eating. If this video helped you finally understand the difference and gave you the confidence to start investing, hit that subscribe button and like this video. We are building a community of people who are taking action, not just watching from the sidelines. I'll see you in the next one.